getting back into it. Entities in federal tax system. You have individuals, you have C corporations. They are taxed at that level. You have flow-through entities, sole proprietorships, partnerships, S corporations. The people at Pearson wanted to separately state out LLCs and LLPs. LLCs are going to be a sole proprietorship or an S corporation. It's more of a legal term than it is a tax term. And then you also have a trust. And we have another video here on, you can see how they operate. I'll go into it in some detail. Video might make it a little more clear. Components of gross income, salaries and wages. That's going to be the main one that you will see. If I make $10,000 working at Burger King, that is earned income for me. I earned $10,000 in income. Investments, interest, dividends, anything you would kind of passively, earn. That's going to be your investment, and they'll flow through, discussed, partnerships and S corporation. So you get from owning a business, that's going to be your partnerships, S corporation, and sole proprietorships. For versus from AGI. AGI stands for adjusted gross income, and you will often hear of the line. For AGI, this is above. You have business deductions, moving expenses. You don't see that on the line. IRAs, retirement accounts are very popular for lowering taxable income, and then self-employed health insurance. If I, let's move to an example of me having an Etsy shop, and I operate this Etsy shop. It's what I do. My health insurance that I will be paying, that is a deduction of up to 50% for me through that entity. And from AGI, now we're below the line. We've got the greater of the itemized deductions or standard deduction. As I think I mentioned in the previous video, you see more and more standard, you see less itemized. That's a direct result of the Tax Cuts and Jobs Act, the TCJA. Taxpaying entities, corporations. This should specifically say C corporations. Counts for only 9% of U.S. tax revenues. We are at the point now where you don't see a lot of C corporations. S corporations are a far more attractive option, but there's some stipulations that go along with the S corporation. So maybe the C corp can't elect that status, but you see, especially in I don't want to say middle income, but kind of that average income for a business. You're going to see a lot more S's than you do C's. Disney's going to be a C corporation. They have to be. The guy who owns the deli that you like to visit for lunch occasionally, and he's not part of a franchise, he's probably going to be a sole proprietorship or an S corporation. C corporations cause double taxation on same income. So you've got a C corporation. Let's go back to Twinkies, right? I start a business and I sell Twinkies. I don't make them, I just sell them. And I make $100,000. And that $100,000 in that C corporation gets taxed at 21% is the current rate. So $100,000, bam, immediately that entity is paying $21,000 in taxes. Now we've got $79,000 left, and let's say I want to distribute all that income as a dividend to me. I pay tax on that dividend. That's where the double taxation comes in. The entity C corporation pays it at the first level. I, as an individual, will pay it at the second level in the form of the dividend received. This is more tax planning, but it's useful information. First level of tax may be mitigated by paying shareholder employee salaries and bonuses. It can be subject to IRS attack. I haven't seen that, but if a C corp went forth with a unreasonable, in the eyes of the courts, bonus, that could be subject to a clawback. Second level of tax can be mitigated with the CRD, corporate shareholders, a reduced rate for dividends received. Don't really see a lot of that. Typically, a dividend received is a dividend received. I'm not going to go into this one too much. It operates very similarly to how individuals would. You can read the slide and pick up on what they're discussing there. Flow through entities. You've got sole proprietorships, S corporations, and partnerships. For right now, think of LLCs as partners, corporations, and LLPs as partnerships. Yeah, an LLC is a legal term, it's not a tax term. S corporation is a tax term. Partnership is a tax term. Flow through entities are not taxed on an entity level. That C corporation that I started, not a flow through, but if I were to convert it, if I were to make the S election, now it's a flow through entity. Now that 21,000 in tax I had to pay for, I'm not paying. Income is allocated to shareholder, partner, member, and taxed at that level. So that $100,000 that I earned no longer subject to that 21% tax rate. It flows through to me on my individual tax rate. So I would get $100,000 taxed at my tax rate. Much more favorable answer for me than the C Corp setup. To prevent double taxation of same income, taxpayers' basis and entity must be maintained. We'll get into basis. Flow-through entities may deduct 20% of qualified business income. That is a result of the TCJA. That's where QBI comes from. Net income from business activities. It's my Twinkie selling. I made $1 million in revenue, and then I had $900,000 in expenses. My income is $100,000. My QBI is $100,000. Calculating basis in flow-through entity. That Twinkie shop that I started. Let's go with, okay, I'm an S corporation, and I put in $100 to get this Twinkie business going. My basis in that is $100. Plus or minus partnership operations. That $100,000 that I made would get added to my basis. My basis is now $100,100. That would be my ending basis. So it's original contribution plus or minus share of operations, income and loss, and that is your ending basis. Let's get into the various tax-paying entity types. We've got partnerships, 2 or more parties that carry on a business. Pretty self-explanatory. Partners can be individuals, corporations, trusts, or estates. I very often see individuals. I don't really ever see corporations. I've seen trusts and I have seen estates. They file a different form. They file a 1065. Similar to 1040, but it's for partnerships. Entity income deductions flow through to the partners on what is known as a K1. I will be referring to that form multiple times because it is the form that you report your share of income from the partnership or its corporation. Net income is not taxed at the partnership level, only at the partner level. That's the flow through entity. Here we've got a slide. Each partner contributes. You can put in. You don't have to put in cash to start a business. You can put in property. So let's say that I put in $100, and I've got a buddy who has a Twinkie making machine, and that's what he contributes. We both contributed property. We both have basis in this partnership. This seems like a good time to pause it, so I am going to stop and continue another video.